Ladies and gentlemen, welcome once again to Forex Trading Beginners class. Today, we're going to look at our fifth topic, which is titled While Trade Forex. As always, I remain your host and facilitator for this program, Halil Ahmed Samuel. And now, moving into the fifth topic, which is why trade Forex. So, why trade Forex? Advantages of trading or Forex trading. There are many benefits and advantages of trading Forex. Here are just a few reasons why so many people are choosing this market. No commissions, no clearing fee, no exchange fee, no government fee, no brokerage fee. Most retail Forex brokers are compensated for their services through something called the spread. So no fixed lot size. In the futures markets, lot or contract sizes are determined by the exchanges. For example, a standard size contract for silver future is 5,000 ounce. In Forex, you can trade smaller lot size or position size. This allows traders to open trades as small as 1,000 units or even lower. Low transaction cost. The retail transaction cost, that is the bid-ask spread, is typically less than 0.1% under normal market conditions. For larger transactions, the spread could be as low as 0.07%. Of course, this depends on your leverage and all that will be explained later. A 24-hour market. There is no waiting for opening bell. From the morning opening in Australia to the Friday afternoon closing in New York, the Forex market never sleeps. This is awesome for those who want to trade on a part-time basis because you can choose when you want to trade: morning, afternoon, night, during breakfast, or in your sleep. No one can corner the market. The Forex market is sufficiently liquid that significant manipulation by any single entity is all but impossible during active trading hours for the major currencies. The foreign exchange market is so huge and has so many participants that no single entity, not even a central bank or the mighty Chuck Norris himself, can control the market price for an extended period of time. Leverage. In Forex trading, a small deposit can control a much larger total contract value. Leverage gives the trader the ability to make nice profits, at the same time keep risk capital to a minimum. For example, a Forex broker may offer 50-1 leverage, which means that a $50 margin deposit would enable a trader to buy or sell $250 worth of currencies. Similarly, with $500, one can trade with it with $5,000 and so on. While this is all gravy, let's remember that leverage is a double-edged sword. Without proper risk management, this high degree of leverage can lead to large losses as well as gains. Deep liquidity. Because the forex market is so enormous, it is also extremely liquid. This is an advantage because it means that under normal market conditions, with a click of a mouse, you can instantly buy or sell at will. You are never stuck in a trade. You can even set your online trading platform to automatically close your positions once your desired profit level, that is the limit order, has been reached, and or close a trade if a trade is going against you, a stop loss order. Low barriers to entry. You would think that getting started as a currency trader will cost a ton of money. The fact is, when compared to trading stocks, options, or futures, it doesn't. Online forex brokers offer mini and micro trading accounts, some with a minimum account deposit of $50 or less. We are not saying you should open an account with a bare minimum, but it does make forex trading much more accessible to the average individual who doesn't have a lot of startup trading capital. Free stuff everywhere. Most online forex brokers offer demo accounts to practice trading and build your skills along with real-time forex news and chatting softwares. And guess what? They are all free. Demo accounts are very valuable resources for those who are financially hampered and would like to hone their trading skill with play money before opening a live trading account and risking real money. Now that you know the advantages of the forex market, see how it compares with the stock market. Why trading forex? The forex versus the stocks. There are approximately 2,800 plus stocks listed on the New York Stock Exchange alone. Another 3,300 plus are listed on Nasdaq alone. Which one will you trade? Got the time to stay on top of so many companies? With Forex, there are dozens of currencies traded, but the majority of market players trade the 7 major pairs. Aren't 7 major pairs much easier to keep an eye on than thousands of stocks? That's just one of the many advantages of the Forex market over the stock market. Here are a few more. It's a 24-hour market. The stock market is limited to an exchange opening hour. For example, in the United States, most stock exchanges open by 9:30 a.m. Eastern Standard Time and close by 4 p.m. Eastern Standard Time. The forex market is seamless 24 hours market. Most brokers are open from Sunday 9 p.m. GMT until Friday at 9 p.m. GMT, with customer service usually available 24 hours 7 days a week. With the ability to trade during the US, Asian, and European market hours, you can customize your own trading schedule. Minimal or no commissions, as a lot of online stockbrokers now offer zero commissions, so this is now less of a factor. Most forex brokers charge no commission or additional transaction fees to trade currencies online or over the phone. Combined with a tight, consistent, and fully transparent spread, forex traders' costs are lower than most of any other market. Most brokers are compensated for their services through the bid-ask spread, high trading volume, and liquidity. The forex market sees an average daily turnover of $6.6 trillion. The stock market sees a fraction of this. Short selling without an uptick. Unlike the equity market, there is no restriction on short selling in the currency market. Trading opportunity exists in the currency market regardless of whether a trader is long or short, or whichever way the market is moving. Since currency trading always involves buying one currency and selling another, there is no directional basis on the market. So you always have equal access to trading in a rising or falling market. Minimal market manipulation. How many times have you heard that Fund A was selling X or buying Z? The stock market is very accessible. The stock market is very susceptible to large fund buying and selling. With currency trading, the massive size of the forex market makes the likelihood of any one fund or bank controlling a particular currency very small. The forex market is sufficiently liquid that significant manipulation by any single entity is all but impossible during active trading hours for the major currencies. Banks, hedge funds, governments, retail currency conversion houses, and large net worth individuals are just some of the participants in the spot currency market, where the liquidity is unprecedented. Analysts and brokerage firms are less likely to influence the market. Have you watched TV lately? Heard about a certain internet stock and an analyst of a prestigious brokerage firm accused of keeping its recommendations, such as buy, when the stock was rapidly declining? It is the nature of this relationship. No matter what the government does, or step in or discourage this type of activity, we have not heard the least of it. IPOs are big businesses for both the companies going public and the brokerage houses. Relationships are mutually beneficial, and analysts work for the brokerage house that need the companies as clients. That catch 22 will never disappear. Foreign exchange, as the prime market, generates billions in revenue for the world's banks and is a necessity of the global market. Analysts in foreign exchange have very little effect on exchange rates. They just analyze the forex market. So here's a quick chart, a quick table to just show you how the advantages of forex and the stocks. So which of they say 24 hours trading? Is forex trading 24 hours? Yes. Is stock? No. Minimum or no commission? Forex? Yes. Stocks? Maybe. Liquidity? Forex very huge. In stocks, man. Short selling without an optic? Yes. For the forex and stock, no. No market manipulation. Forex, it depends. Stocks, there is always a market manipulation. In the battle between forex versus stocks, it looks like the scorecard between Mr. Forex and Mr. Fox. Mr. Stocks shows a strong victory for Mr. Forex. Will it go to 2-0 with Mr. Futures? Why trade Forex? Forex versus futures. It's not just the stock market. The Forex market also boasts of a bunch of advantages over the future markets, similar to its advantages over stocks. But wait, there's more, so much more. Liquidity. In the Forex market, $6.6 trillion is traded daily, making it the largest and most liquid market in the world. The market can absorb trading volume and transaction size that dwarf the capacity of any other market. The future market trades a puny $30 billion per day. 13 billion, peanuts. The futures market can't compete with its relatively limited liquidity. The forex market is always liquid, meaning positions can be liquidated and stop orders executed with little or no slippage, with exceptions on extremely volatile market conditions. A 24-hour market. At 10 p.m. GMT Sunday, trading begins as market opens in Sydney. At 12 a.m. GMT, the Tokyo market opens, followed by London session at 8 a.m. GMT. Finally, New York opens at 1 p.m. GMT and closes 10 p.m. GMT. Now, before New York trading closes, the Sydney market is back open. It's a 24-hour seamless market. As a trader, this allows you to react to favorable and unfavorable news by trading immediately. If important data comes in from the United Kingdom or Japan while the US future market is closed, the next day opening will be a wild riding. Overnight markets in futures contracts do exist, and while liquidity is improving, they are still tinily traded relative to the spot forex market. Minimal or no commissions. With ECNs, that's electronic communication brokers, becoming more popular and prevalent over the past couple of years, there is a chance that a broker might require you to pay commissions. But really, the commission fee are peanuts compared to what you pay in the futures market. The competition among spot forex brokers is so fierce that you will most likely get the best quotes and very low transaction costs. Price certainty. When trading forex, you get rapid execution and price certainty under normal market conditions. In contrast, the futures and equities markets do not offer price certainty or instant trade execution. Even with the advent of electronic trading and limited guarantees of execution speed, the prices for futures and equities on market orders are far from certain. The prices quoted by brokers often represent the last trade, not necessarily the price of which the contract will be filled. Guaranteed limited risks. Traders must have position limits for the purpose of risk management. This number is set relative to the money in your trading account. Risk is minimized in the spot forex market because the online capabilities of the trading platform will automatically generate a margin call if the required margin amount exceeds the available trading capital in your account. During normal market conditions, all open positions will be closed immediately. That's during the fast market conditions. your position could be closed beyond your stop loss level. In the futures market, your position may be liquidated at a loss bigger than what you had in your account, and you'll be liable for any resulting deficit in the account. That sucks. So here is a quick table to just show you advantages of Forex over the futures. 24 hours trading, Forex yes, futures no. Minimal or no condition, Forex yes, futures no. Up to 500 to 1 leverage, Forex yes, futures no. Price sensitivity, again, Forex yes, futures no. Guaranteed limited risks, finally, Forex yes, futures no. Judging by the Forex versus futures scorecard, Mr. Forex looks unbeatable and now meets the winner who trades the Forex market. That has been the end of part 5 of our class. So hope you've learnt. So our next topic will be about margin trading 101, understanding how your margin account works. As always, for any questions, inquiry, you can reach out to me on any of the following platforms at your own convenience: Facebook, YouTube, Gmail, Telegram, Twitter, of course, my WhatsApp, they're all here. Hope you've understood, but if you have any challenges, reach out to me and I can give you more clarification. Thank you and see you in the next topic.